So, all right, Jesse, it's time for Should I Do That? Making sense of expert financial advice. This is the part of the program where we take articles from popular money magazines or money publications and dissect the expert advice. And I say expert with a little tongue in cheek. We like to have fun with this. We don't want to name these quote experts, but we're going to see how much this advice applies to the typical investor. All right, Jesse, go ahead.
All right, so our first individual here, this person is a portfolio manager at a very large mutual fund company that probably a lot of you listening might own the mutual funds and not even know about it. But so this industry loves their acronyms, right? So this guy's throwing a new acronym called GARP, G-A-R-P, growth
GARP.
at a
Is that
reasonable.
a fish?
It sounds like a fish.
Isn't that those things? Those the ones with the long beak on there. That's a gar. Okay,
That's a
all
gar.
right, never
we
mind.
got gar and we got carp.
GARP.
I guess
Okay,
they could
not to be
breed,
confused
be
with gar. This is GARP. So we're going for GARP.
Going for growth
What
at
is
a reasonable price. So in the market, there's growth and there's value. They're kind of contradictory types of companies. And he's saying to buy growth stocks cheap.
Okay, so buy the dip.
Yeah, buy the dip.
Okay, buying the dip because they're cheap.
Mm-hmm.
Okay, so they going up?
Maybe sometimes.
Okay, well, we don't know.
We don't know.
I got to question sometimes these folks that put these things out here. So, what are they basing this on? Is this because they have a lot of mutual funds to sell, or they're trying to keep people in those mutual funds because people have been jumping out of those mutual funds, especially the growth ones, over the last 6 months?
It could be. This individual claims that year to date, GARP funds and GARP stocks have performed in line with the market in a positive way, and they can help. They're all weather style, so they're tough, which I don't know if I agree with.
But they can struggle when inflation's accelerating.
Yes.
Okay.
So I don't know how I feel about this individual. I'm sure that GARP works really well sometimes and really not so well other times.
Well, there's nothing wrong with having growth-oriented mutual funds or stocks in your portfolio if that's what you're looking for. But you have to know that with that growth-oriented perspective, you're going to have some volatility, and you will have some really good years and really bad years. And at the trough in June, growth was really struggling. I mean, growth as an asset class was really struggling, and we saw the NASDAQ down over 35%. Even the large caps were down 24-25%. So it depends. Are they due for a rebound? Yes. Have we reached a market bottom? I don't know. The market bottom may not be in. So you have to ask yourself, is this right for me? It can be, but you need to talk to a financial professional that can actually ask you about your particular situation, your unique position that you have, or perspective, and your objectives and everything else, to make sure that GARP is a reasonable and suitable thing for you as an investor. So, okay, so we got the fish recommendations.
Yeah, go fishing
for investing, and lo and behold, they even have an ETF and a mutual fund that you can purchase.
Based on this
from
advice.
them that will help them look at this. I'm looking at a chart at the ETF that they're telling us about. We don't talk about products or particular securities on our program, but I can tell you the general trend is like this. So it goes down. It goes down through the month of May, and then I went and looked up this particular ETF, Jesse, through the month of June, and it went down even further. So we'll have to see how this one goes. Who's next? Who's giving us the next bit of consumer investor advice?
So our next individual has a very different approach.
Okay.
This person says
this expert.
This expert says the best strategy is defense. And there's such thing as defensive type of investments, but I think this person literally means defense.
Oh, like
So
defense, like
like
defense
aerospace,
companies, aerospace, rockets,
missiles, rockets, that kind of thing.
missiles. Okay, all right, I got it. And why was that?
Uh, they claim that with all the crisis going on in the world, these things have a lot of potential. And in terms of growth, the global economic growth has started to wane. So we should avoid that and stick to these companies that
What? So
supply
he's telling us
weaponry and
the
whatnot.
opposite of the other guy.
It's essentially the exact opposite. And
Okay,
there, and
so defense sectors. All right. So what do we think about that? Well, okay. I guess that defense can play a part in your portfolio. The thing is when they ask these folks, and I mentioned this last week in the last episode of the Should I Do That program. The last episode I mentioned this is like uh, they're just trying. You get asked by these reporters to make a comment, and you try to come up with something unique, and you hope your compliance department approves it. And this is what they come up with:
mhm.
buy defense. Well, that can play a part in someone's portfolio if it's suitable for them. There's certain risks that are involved with any type of investment, but we want to make sure that you talk to a professional financial advisor. Who's next, Jesse?
Okay, so this person says that they are a wealth advisor with a very large firm, and they suggest to seek out well priced inflation hedges. So they say that the biggest movers and forces in the market today are inflation and interest rates, which is a great statement. But their advice is to seek out inflation hedges.
Okay,
So,
all right. Well, that kind of makes sense, right? Except for the fact that the stock market is always forward looking.
mhm.
And those inflation hedges are looking for a time when inflation drops. And so, will they remain profitable? Well, maybe so. But you have to realize that you are looking, and when you buy a particular security or stock, that is a forward-looking price. And
Mhm.
so, investors in the markets behave in a way that is forward-looking.
I think this
So,
person might be appealing to people's emotions because, especially in this market that we're in, being stable really sounds nice, doesn't it?
well, stable, and really what they're really driving is aren't you afraid?
Mhm.
Aren't
Aren't
you
you afraid?
afraid that inflation and interest rates are going to get so crazy out of hand that it's going to be like the early 1980s and late 1970s? Fear, fear, fear. That's the number one driver of financial news media is fear about something, or even worse, the FOMO, the fear of missing out. It's still about fear, isn't it? I
Mhm.
fear I'm going to
Definitely.
miss out, or I fear I'm going to be punished for holding a certain type of investment. So this could be value stocks, perhaps, right?
Yeah, it could be things that tend to do well in high inflation environments, stuff like that.
Okay, companies that have good fundamentals. These are all positive things to look at.
Mhm.
So I don't necessarily disagree, except I think that she probably has missed the boat on this one as far as it happening already. I haven't looked to see what the Treasury inflated securities look like, the tips and things like that. So, it could be part of your portfolio if we continue to see high inflation, but you got to be careful. Remember that stocks are always forward looking, and that may have already passed.
Mhm.
Okay, who's
Okay,
next?
our next person, their title is called Darkness Then Dawn. Very dramatic.
Oh, my
Uh,
goodness.
so this person is, in a very roundabout way, not giving any direct advice and just saying, look for cyclical stocks and then time the cycle and get in at a good time based on the movement of different areas of the market.
See, there's nothing wrong with this advice, looking for cyclical type things. But I think what they're really trying to say is that look for the things that have underperformed and buy that,
Mm,
because they eventually have to come around, right, Jesse?
they do.
And that's not the thinking we have here in our offices for the financial advice that we typically give. Because
Well,
go ahead.
yes, definitely. I was just going to say a perfect example is the market sector of consumer discretionary, the things that we want, not necessarily the things that we need.
Sure.
It's been underperforming for a long time this year, and it's recently made a turn. That doesn't mean it's going to continue, but that's an example of something that is cyclical.
Okay. But, our approach to money management has nothing to do with modern portfolio theory, trying just to rebalance. And that's what happens in your portfolios if you have them automatically rebalanced. And a lot of times advisors will simply just do this and call it, portfolio management. But they'll basically sell the things that are doing well and buy the things that are not doing well or underperforming,
Yeah.
because they go in these cycles. Unless, you're what if you're investing, 7 or 8 years ago in emerging markets? Well, they've underperformed for some time. How long of a cycle am I going to ride when it comes to an underperforming market?
Mm-hmm.
Well, just be careful. Don't buy something just because it seems like it's cheap or it's been down for a while and it'll once make a reemergence, because that sometimes can be years. You want to make sure that you're buying into investments that have strong momentum, and hopefully the momentum will carry them onward even higher. It's kind of the opposite of what we kind of look at here, what the industry looks at in their style of rebalancing, is to just basically sell the stuff that's outperforming and buy the stuff that's underperforming. That's called rebalancing, and that's not really the most effective way, we think, to manage your portfolio.
Mm-hmm.
All right. So, and of course, there are all sorts of things that are making, because even this person, Jesse, talks about that markets typically discount future events, many
Yeah.
months before they occur. This is what we're talking about.
But
And
that's not to say that they think they can predict the future.
that's right. It just means that the market's looking for, like in the last couple of weeks, the market's been behaving like the Federal Reserve is going to start cutting interest rates in next February.
Mm-hmm.
I don't think that's going to happen, but then again, I don't have a crystal ball. But that's kind of how the markets have been reacting, and they even reacted to today when we're doing this and this program, because the CPI numbers came out and they were flat. They're still 8.5%
Yeah.
year over year. That's nothing to get excited about, but the forward-looking folks and the investors are saying, well, surely the Fed has to slow down its interest rate hikes. I don't think that's going to happen the way people are predicting there. Okay.
Yeah.
So, Jesse, when we got a couple of minutes left, why don't we give just a brief overcap of the markets year to date?
Sure. Let me pull up my charts here, but we're going to start off with the S&P 500, which is the large cap stocks in the U.S., the 500 largest. And as of the time we are recording this, that is minus 11.86 year to date. So it's had a rise. We had major resistance at 41.77. So we will see if it closes above that. But let's move on to the NASDAQ, unless you have a comment on that, Mark.
No, we're really looking at that resistance. 41.77 on the S&P when as we're talking today, that's the major resistance.
Mm-hmm.
I think it's above that right at the moment, but we just have not been able to close above that level.
Mm-hmm.
If that level is significant, I think there's a potential for more upside in the market should it begin to break out from that. If not, it's possible we have another retracement.
Yeah.
Bear market rallies are very common during a bear market, where it just begins to roll over again. So that's the caution I would use. I don't think the bear market is over. I think we got some time to go. Go ahead, Jesse.
Okay, I'll just quickly run through the rest of the indexes. The NASDAQ, which is the tech-heavy sector or tech-heavy index, is down 18.11% year to date. The Russell 2000 small cap index, these are smaller companies that you probably hold a small amount of. That's minus 12.2% year to date. And the last one we'll look at is the long-term Treasury bond fund. It's just not fund, index. It's a Treasury bond index. Minus 21% year to date.
Okay. So still, we're not out of the bear market. We got still a big drawdown year to date. That's
Mm-hmm.
not even from the peaks.
Right.
Some of these, like the Nasdaq, peaked last November, and we're acting like there's some momentum kind of go to the upside. But I tell you, be cautious, because that doesn't mean that it's going to continue.